Hey Trent, how are you, man? Welcome, folks. We'll let a few people come in just to let everybody know that it is being recorded tonight. So just keep that in mind. Hopefully, everybody consents. It'll make life a lot easier to upload this after the fact. Welcome all. X2, do you mind if I make you co-host? Just open up some spaces. Is that cool with you? Hey Trent, I might actually invite you too, bud, if that's all right. It just
Sure.
opens up spaces for speakers. Thanks, man. Perfect. All right. Hey, Brian, good to see you. Gavin, Leslie, Dibsy. Got a lot of returning faces here. George, Bill. The list goes on and on, guys. So appreciate your time. Excited to get this one started. We, yeah, got a few things to obviously to talk about, review, a little bit of, I think we ended up where did we end up? We end up in the F bucket or just the chop bucket at the end of the day? I think it was the F bucket, but hold on a second. Let me not, yeah, we'll call it the chop bucket still, 23.85. Definitely. Hold on a second. Mike Taylor's trying to join. Now that is exciting. Hold on a sec. I'll share this. Hey Jimmy, can you? Oh no, I got it. I got it. Never mind. Kevin, perfect. Sorry, guys. Sorry for a bit of the dead air here. Apologies. Just kind of getting ourselves sorted.
No problem, man. What's up? Good evening,
Yeah.
guys.
No, good. I was gonna ask you to send it to Taylor, but he just joined. All right. I'm not even this is fabulous. We got Mike T in the house, baby. Awesome, bud. Thanks for joining. Appreciate it.
Oh, it's a load of shit. This is clearly an imposter.
The troglodytes unite inside of Hedgehog Nation. This is awesome. What a great,
Wait, I love your dig. You're like, Taylor, the pink fund is down. Abandon ship. Abandon ship. I actually know you got to realize there are so many Twitter people that don't understand stuff, and I had to put the chart up and be like, yeah, like my nearest competitors are 7 to 17% underperforming the pink fund. So and in vanilla
That's
land,
wild,
that's
right?
like retarded. So
Yeah, it's
Yeah.
it's ridiculous. I mean, and their fees are about I'm
twice,
yeah. I
twice
was
my
gonna say
fee.
three
Some
times
are,
your
some
fee,
there's a
maybe.
couple
Yeah.
that are
So yeah.
130 bips. So
Right. Right.
That's a
So
tough way to start thinking about the quarterly write up
oh, they
in
don't freaking
institutional
care. They
land.
got them all lassoed in. That people don't even know.
Yeah.
It's all
no,
about
I mean it's
distribution right now, and the
yeah,
people
it's
don't even
mutual
look.
funds.
So to,
Yeah.
to build this pink fund, it'll take about a year of doing that before they catch on. Oh wait, holy shit! Is that? Oh, I thought that was. Is that Mike Green? Oh, you got to put Mike
Um,
Green on live. Come on.
um, I mean,
I mean,
he's got a request.
he's a chump and everything, but
I mean, he's got a request to speak. I can't force anybody to speak here, Mike T. Right? But I will say, I mean, a little humble brag here. He did follow me a few minutes ago, so I'll take that little that little
Nice.
feather in my cap tonight. So cheers, Mike or Michael. It's great to have you on as well, Professor Plum, as always. So Mike T, I know you're kind of fresh to this, but we've been doing a weekly notebook review, excuse me, since about just before Thanksgiving. So we kind of just walk through what we're seeing out there in the market.
yeah.
What's standing out kind of from our review over the weekend. Where most of us are in our notebooks, kind of setting up for the week. Many here inside of on the retail side of Hedgehog Nation. We
All
all kind
right.
of a lot of us have a day job, stuff like that. So we got to kind of do a lot of prep ahead of time.
I
So
know, isn't that awful? You should
yeah,
stop that.
I know, right? I think a lot of us would like to just do it full time, but anyway, it's so we kind of take tonight just to kind of walk through, see what we're seeing, what moves we've made in the last kind of today short week, so last 48 hours, and kind of how we're setting up for the end of the week. Obviously, we got OPEX on Friday. So expecting probably a little bit more of a, the fuck bucket as we head into
I have
Friday.
so much to talk about on this,
Yeah,
by the way.
let's.
I've been tweeting a little bit like mad.
Yeah, I saw that.
Uh, so I'll tell you
So
how I'm
yeah,
set up.
why don't you
And
just
I
lead the
told
charge?
you guys what I'm doing. You heard me talk about the Qs, and the Qs 3 weeks ago, the puts were really cheap, by the way. And on the and also on housing and on the housing beats that just came like what 4 days ago or something, I just shorted the goddamn bejesus out of the whole thing. So how I'm set up right now, I have about a 30 $32 million book on, and it's short because all my puts went in the money now. It's short 71%. Is that bad? So that's how I'm set up.
No, the trick is
And
to cover, right? Like a partial cover, a short cover, kind of work your way back. It's
No,
almost house money.
no, I haven't. I'm it's only short now because all my puts went in the money, and I just started making money on it the past 2 days. So, because I basically bought a blanket of puts out there in larger caps. So this is what we've seen so many times, and I've been talking about all my critical mass guys. And critical mass is the hedge fund that I used to run, and virtually all the guys from my fund are now starting their own funds, and they've just done really well. So it's about six guys that I talk to constantly in healthcare because they all worked for me, and then I have a wider universe of about I don't know 30 to 40 PMs that I stay in relatively close contact with, where we're talking every day, every 3 days, something like that, but usually every week at least. And just talking about names, talking about setups, and these are people that I've all come to know and appreciate over the past 20 years. And the setup is very, very, very difficult. If you don't know, in healthcare at least, and also a lot of TMT funds, these guys are down 20 to 60% year on year. These are unbelievably horrific numbers. And what you may not be aware of, over the past 2 years, we have seen a deluge of IPOs and new companies coming on in all spaces, especially in healthcare. And my bankers tell me that there's at least $50 billion of financing in biotech that has to come this year. P.S. All the major hedge funds are down 20 to 50% or more. So they're not going to be the ones. First of all, they own all this shit and they can't finance them. So the only person that's left to finance them is the vanilla retards. Oh, that's me at Pink. So they have to, and these guys aren't going to step into this shit unless it is like
deep
beyond dirt
discount.
cheap. They are just
Yeah,
not
deep
going to
discount.
even care. So,
And
I
just for
look at.
those, so Mike, just for those that aren't as familiar as kind of some of
Oh, I
us are
should
in terms of it.
introduce myself. I'm
No, no, no,
sorry.
no, 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 no. You're good. You're good. You're good, Big T. No, just more in terms of like why biotech. Why you already know that there's that number of kind of dollar flow that's basically needs to come to market in 2022. Just to give some folks a bit of background there.
Sure. Okay.
Yeah.
So I'm a scientist, virologist. I ran a hedge fund, and I ran some of the bigger hedge fund books at Citadel and Millennium for most of my career. My career spans about 20 years. And I recently departed the hedge fund land to look out the window and so forth. I started this Pink Fund, which is the fees go to the Susan Komen Foundation. All the profits go to you, of course. And so
So
I'm doing it for free.
so that
And
ticker's PINK. Just
PINK,
PINK.
Pink,
It's great.
Pink.
Yep.
And it's a benchmark to the MSCI U.S. healthcare benchmark. So that's really my goal, is to beat that. Last quarter, we put in about 400 basis points above the benchmark, outperforming I think every actively managed fund there is in healthcare. And now it's much worse, where those actively managed funds are down a lot generally, and I've underperformed the benchmark this year to date about 150 bips, and I apologize for that. It's been a very, as you can tell, if you had any idea, like any position on with any alpha, like, ooh, they're going to beat the quarter, you're dead. Didn't matter. It's going down 20%. And that's pretty much what happened. Very difficult to escape. And I've seen this before. And so what we've seen many times before, because I talked to all my guys and I've been doing this for a while, is that the small caps, when they blow up like this, and they have blown up in epic fashion, I mean, just really something. In about 2 months later, the large caps catch down if the Fed is not playing ball, and they are not playing ball big time. So in the reverse, if it was more of a QE environment and we had a big sell-off in small cap, I'd be getting massively long because they're going to catch up to where large cap was.
Sure.
And that's and right now the large caps actually are probably staring down the barrel of a 10% drop from here.
Right.
Across the board.
So, Mike, I was going to ask you that in such a scenario, wouldn't the small caps in biotech bid less, especially with passive flows about to come in form of redemptions?
Well, that you made a great point, and it is distinctive because they will get notice on the March quarter, meaning at the end of March they have to deliver the money that the investors want back, and the redemption notices will go in on Jan 31st and on February 15th. So it depends if you have 60-day notice or 45-day notice. As for the managed accounts, so there's something with hedge funds carry is like really fast money, and it's called SMA, a single managed account, where the hedge fund is basically running their money. They can get their money back at any time. Like, thank you very much, good night. And I know of one fund so far that just a good friend of mine just shut down on Friday, and that's Asymmetry Capital. It's a guy who puts up a good year for him as teens. And I think his CAGR is about 8%. What's that?
Sorry, Trent?
I was saying they had $1 billion fund or more. They had 2 or 3 funds. Asymmetry had almost minus 40% year to date by November itself.
Well, maybe some of them, but net, my allocator, who's an investor in it, told me it was 22%. So. Yeah, so I'd stick with that number because he's an investor, so he actually knows. Sometimes they'll have different funds, and the big one, he's talking about the big one because I think he was probably 20% of Scott's fund, and that's Scott K. Very nice guy, by the way, wonderful guy. I've known him for 15 years or more, and he was down. His CAGR for his fund was about 8%. He dropped 22. And, all of those funds are in deep shit, the guys with like modest returns, and then they have a big dipper because he can't pay his guys, meaning that, hey, it's going to take a year to get out of this hole. Can't pay you that year. And then it'll take another year to make up the money to your high water mark and above. So you basically need 2 years of great returns in order to get your guys paid in 2 years. And a lot of these funds are going to be looking at like Logos Capital and many others that are over $1 billion. And it's going to be very, very, very difficult. They're 40, 50% down. It's going to be very difficult to keep the lights on. And it's going to be hard for the investors to stay there. And so I think that we're going to have some meaningful redemptions between here and February. They'll get the notices and they'll basically have to be selling into March. And that's
Mike,
basically.
Do you foresee any of these funds shutting the gates?
That's what I'm saying. They're going to be redeemed away. They're going to say, okay, we can't make it. So they'll probably.
No, I'm referring to shutting the gates in terms of limiting.
Oh, most funds don't have that latitude.
They don't.
They do not. Most funds, and I mean most funds, cannot say no. We're not giving you your money back. There's very few funds that get bought into that have that written into the contract. Now, I know Ackman has done that in the past, and a number of credit funds can do that in the name of liquidity, but that is not the case here.
The reason I'm asking is because imagine if one of these big funds does that, you're going to see the market react the way it did in 2007.
You may see that happen anyway, because all of these funds need inflows to fund all these biotech companies, not outflow, meaning they need inflows because they have to finance $50 billion worth of biotech stuff. And TMT, smaller cap TMT, is the same thing. And that's why all these companies have gotten absolutely massacred in a way that I just, yuck. I mean, really smart people that I know are down a lot, like 50. And I mean, yes, that's incredibly irresponsible, but meaning that, like, I mean, okay, you're also talking to a guy who I had a flat return. I was at $200,000 in 2011, and that was the worst year I ever had in my career. So I've never had a down year in 20 years, and I just can't imagine the irresponsibility of these managers to put up negative 40. I mean, what the hell were you running? What are you running? What is going on? It's like I feel embarrassed because some of these guys are really, really, really smart, many of them, and so what's going to happen is that there is right now just collateral fallout, and the collateral is, yeah, you got a good idea, that's fine. The problem is another hedge fund that blew up owns it, and now it's down 20%. So because they have to liquidate everything, and that's the kind of shitstorm that we're running into right now, and we're not even there yet. That's the point. We're not even there yet. It hasn't happened because you had a horrible quarter concluding a difficult year. And many of the allocators that have their money with them will say, oh, okay, we'll give them one more quarter, right? We'll see give them a whole quarter. Come on. They're down 50, 60%.
I wish I could.
But the numbers are so shitty. The numbers are so shitty right now that they're probably going to be like, and the first out is going to be the most happy that they got out. Because if you look forward, and I was talking to a lot of my friends, Mike Green included, and I was like, what a better setup for markets to go up in smoke after $14 trillion of stimulus, trillions of dollars of stimulus checks. Every single person under 30 years old is up to their eyeballs in crypto. They don't even know what that is. And they all have a Robinhood account that's levered 8 times. And the call volume's off the charts. And the Fed is telling you that I'm walking away. I'm like, what spells a top better than that? And I think that's what we're running into, and the large caps haven't hit there yet. So I think that TMT and healthcare are still going to have a very, very, very difficult year. And I've actually been looking for a bounce, and that's what I wanted to get to on this options expiration, because and it's something that really bothered me today, and I should have put a chart up for it. Aside from Pink underperforming today by like 10 bips, I was like, what? I have a zero weight in Moderna. How could I be down? Okay.
So Mike, quick question for you. With Orbimed down 40% or more, with Perceptive down 30% or more, and all these are smart guys, right? So these people have like PhDs and whatnot in their teams.
Joe Edelman, who runs Perceptive, is one of the smartest people on this planet.
Yep.
So,
consonants.
And he's betting it all on SWTX, by the way.
Yep. And do you think that some of the larger players would have opportunities trying to gobble up, taking advantage of this sell-off, meaning Pfizer's or Merck or Bristol Myers taking advantage of this?
Yes, and if I draw your attention to the Pink portfolio, I happen to own some of those things that I think that they will buy. But it didn't matter because those things, except for United Therapeutics, like I think that Perceptive might have sold Horizon Pharmaceuticals in the past 2 weeks and just drilled that thing down 20%. So that was one of the things that hurt Pink. But so I have some outsized positions in those names so if you look. So let me I'll just talk about the market setup, and then we can talk about specific names. And I think that's so cool that you know about this stuff.
Just to set for the room, Robert has shared a tweet at the top of the room where you can see a complete thread in which you can keep just scrolling and find out all these names which we're discussing right now, and their holdings as well, their top holdings, which were as of December.
Well, okay. So here's what bothers me about the macro market right now is that as of right now, the put call ratio is 0.55, and that is nowhere near panic, even remotely. So people, believe it or not, do not have enough protection on. And I'm worried about that. And I think that is going to change if the Qs slice through the 200-day tomorrow. And I think it probably will, because the S&P did not even remotely hold the 100-day. So
And so, how, Mike, when you're looking at stuff, I mean, how much do you overlay kind of your general macro view versus some of the technical analysis that you share on Twitter and stuff, and then other components as well?
That's a great question. So for large caps, I pay attention a lot to technical analysis, and almost not at all for the SMID caps, because they just don't have what I've learned discovered over the past 10 years is that technicals for that entire group has become less and less and less important, unless like it's a small cap that becomes large, like Moderna.
Sure.
And Moderna just broke the $200, which was huge support for them. And once it just dropped $25, I think today. And I think that's going to $113 in the next month or two, because everyone's going to find out they're screwed. But whatever. That's neither here nor there. But what really bothered me, the put-call ratio isn't high enough. So the S&P just broke through the 100-day like it wasn't there. It didn't even attempt a bounce today. It was very weak. And the Q's attempt at a rally, we opened up 100 bips, went up to 150 bips. And then by 11 o'clock, the selling started. And that really bothered me during options expiration, because I really thought that after, I'd hoped that after such massacring in the TMT and the biotech spaces, and a lot of spaces, you're seeing brick and mortar retail starting to get railed for good reason. And it just makes me, it made me think that we've gone a little bit too far. We need to bounce, and the fact that even during the broker dealers are hedging up right now and basically closing out their bets, as we approach this expiration, and they're taking off their hedges or whatever, and it's just not moving anything, and that makes me think that there's actually a lot more selling to come.
I mean, the volume was pretty sized today too. I mean, it started off kind of slow, which is really why I personally, was like, I saw the bounce, especially in Qs and stuff, and I was like, all right, I'm going to start leaking shit out there. And then the volume started picking up, and I just got more aggressive and really basically turned cold on I just got rid of pretty much all my tech once that volume started picking up, and because exactly to your point, Mike, right? Because it's just like it seemed like it was right for a bounce, right? I mean, I actually put on calls, like NASDAQ calls yesterday going into today, thinking, okay, like this has got to, and it bounced right out of the gate, but just could not get through and kind of muster up any energy on any strength or any volume, I should say.
Yeah, I bought biotech calls on Friday as soon as Teladoc went green, because I was like, oh, we are going to get the bounce. Holy shit. Right. And so I bought notional $3 million of biotech calls, and it went boom in the money. And then I was like, oh, we might actually get a rally. And then poof, gone on Monday. And I just closed out the remainder today, even though biotech was a little bit up. And I was just like, oh my God, this is going to go to zero. I bought the ones that expire on Friday. I really hate trading like that, because it's just a dumbass trade market. But I was so short because all of my QQQ puts, and you guys were following, I told you I went size in the U.S. housing stocks short, and speaking of which, I don't know if you saw the hedge I called this morning with the guy. He's like, yeah, I like the housing stocks. It's good because, and then he goes on why it's good. He goes, oh, the earnings are really good, and the Fed is going to make a terrible mistake. And once they realize their terrible mistake, these housing stocks will really rip. And I'm thinking, that's like 8 months from now. These stocks will be down 40% by then.
Well, we're lucky because that guy Rob Simone happens to be listening in right now.
Oh, he is.
So
By the
hey,
way, he's a
yeah,
wonderful guy.
Let's invite
He's
Reed
as
Rob is the
equally
best.
good looking as he is brilliant.
I know he is.
Rob.
He's great, Rob. You got any
Big
rebuttal there,
props.
big
Hey, but he's dead right on
Come talk to us.
Crocs. Okay, totally right on Crocs. So I mean, you can't get them all right. Yeah, it's I just disagree because I'm like I look at this setup and I'm like, you basically have max pricing, max consumer, max free money to consumer, max everything, and a Fed that is basically going to stick his fist up your ass. So I have to go bearish.
Hey, Mike. Thanks for the kind words earlier. Appreciate that. By the way, that wasn't me. I think that was my that was my colleague Josh. I actually don't.
Josh.
Oh, okay.
I'm
Yeah.
sorry. I don't know all the people.
No. Housing isn't. I do rental housing, so the single.
That's different.
Yeah, the single
Totally
family
different.
rental REITs.
And we
My
kill
bad.
it in rental housing.
Yeah, so I've been long AMH for a while now. That's one of my favorites on the long side. But yeah,
But isn't that yield on that, if I recall, like 1%?
No, it's just south of 4.
Oh, I take it all back. I was looking at some other. It was like 1%. I'm sorry.
Just south of 4.
That's a great yield.
It's
and
a great.
Probably got pricing power.
Oh, I'm sorry. But by the way, you're talking about the dividend yield, right? You're correct about that.
Yeah.
I'm thinking whenever I'm a dumb real estate guy, whenever I hear yield, I think of the NOI yield or the implied cap rate.
No. So the dividend yield is 1%, right?
It is, and there's a good reason why. And this actually gets to why the stock's so interesting. So they're actually hoarding cash to fund development, and and so they're using their 4% cost of capital to go out and build single family rental homes to like a 6.5 to 7% yield. So it's incredibly accretive. It actually makes sense for them to have a low yield and to kind of defer that payout into the out years, if that makes sense.
No, I get it. I just bought a whole bunch of rental properties.
Yeah. It's
with a partner, and we have a 17% yield.
Where?
Because we were just looking for.
Is it a 17% cap rate, or is that the leverage?
Well, I did it with all cash.
That's probably their levered yield.
Can you help with it again?
No. That's a unlevered.
Really?
Yield.
Wow. Where?
Yeah.
Is this like in the Midwest? I mean, I bought some.
No, it's in your favorite place. It's in New Jersey.
Oh, interesting.
I did it in New Jersey because there's this area in Western Jersey that's like near a military base. And the Amazon is putting in a big warehouse there. And so there's going to be thousands of new jobs.
Oh, sure.
And so so we picked up, we're probably going to try to pick up 30. But right now we're only at 12. And we were looking for just busted landlords. There's so many busted landlords now because, they have 25% of the rent roll not paying. And because you couldn't evict them in New Jersey for the past 2 years. So these guys
didn't have the appetite. Yeah, they didn't have the appetite to follow on with legal action because the collection procedure is about 18 months out.
Our evictions are really quick. They're 6 weeks. So evictions, you can now get them out. But these guys couldn't wait because they were so underwater on their own private finances. Because I didn't know this, but the landlords, they basically live off of these checks and never invest in the property.
Yeah.
So all these properties have just turned into dog shit. And they just can't fill them, and the people aren't paying anyway, and so they just have to cut loose.
So Mike,
and they got gains in it because they bought them for peanuts 20 years ago. So they're just cashing.
Mike,
out.
You may know this, but of the single family home stock in the U.S., only about 13 million homes are rentals, and believe it or not, the institutions, including the REITs, only control about like 3 to 4% of that 13 million. So it's an incredibly fragmented market with lots of mom and pops, to your point. And so I imagine you being in this really sweet spot in 5 or 7 years or whatever to sell to an institution, like build a portfolio, and that's your exit. If I'm thinking a couple.
That you have nailed it stone cold. And I think we're still going to have pricing power on the rents because we are able to put in $30,000 of CapEx into each unit. And basically get it appraised. So we're doing this now. We're getting about $30,000 in each unit. We're getting it appraised at a value that is about 60% than what we bought it for. And I'm able to pull out all the cash that I put in, 100%.
That's great.
So we just started doing that. We're financing it at 4.7% 30-year paper through Vizio lending.
That's great.
And it's after that, it's only going to be, after all our bullshit, it'll only be like our taxes and all that shit.
Yeah.
It'll only be 8% yield. But that's an 8% yield that I have zero cash in. And it just, keeps sending me checks. And they're not huge checks, whatever. I just wanted to diversify. Actually, I'll tell you what I wanted to do. I'm basically just using it as a vehicle to sponsor my son for his go-karting stuff. Because this thing costs a fucking fortune. So I'm gonna hit Keith up too on Hedge Eye for a sponsorship for we'll put Hedge Eye on the cart and on his suit and shit. So, and Pink is sponsoring him too. I figured I'm doing it for free, so they might as well sponsor Max.
Yeah.
So that's all. Because if you saw how expensive this is, you fucking die.
Nepotism at its finest, eh, Vic T?
Hey, Mike, I just wanted to say hello and thank you. I'll go on mute. I don't want to hog all the space from you guys. I'll just listen.
Rob, and that's
whatever
that's
whatever you want to talk about.
I didn't get a chance to listen to the call this morning, so I apologize. That's my
no
fault.
worries.
By the way, the call this morning was absolutely sensational.
It was the first one that went live, right?
It was just, I'm going to listen to that every time. The whole problem is now you don't have to listen to Keith when he talks at 9.
Right, everything's already out there.
Yeah, it is just fantastic. That is a great call.
Yeah,
so.
It is. All right, Mike, was there anything else come from a setup standpoint? How were you? Can we take maybe 2 steps back? And you said 3 weeks ago puts were dirt cheap, right? But
yeah,
I mean, did you? What were you seeing, or what was kind of some of the underlying currents that made you really go, and buy up those kind of triple Q?
Well, why I did this size? I'll tell you why I did this size is because first of all they were relatively cheap, and I was like, okay. But there's a handful of names in my long book that I do not want to sell.
Got it.
And because I think they're 10x returns over the next 2 years. And I don't know when they're going to figure it out. I mean, that's always the case. And there's just massive selling small cap. So I wanted to be able to hold on to those. And the only way to do it is to basically put on such a ridiculous short book if this does happen. So I basically risked I don't know, $400,000 in order to have.
And not to give people an insight, but just in a basis point structure, what was that?
Oh, I'm sorry. Okay, so yeah, so I mean,
just make it a little bit more realistic for this.
Yeah.
Little guys.
I get it. I'm sorry, because this is my PA, and this PA that I run is like a section of my wealth, and the rest of it is in housing, hotels, and hedge funds.
Exactly.
And that's kind of how I'm set up, and a handful of other private companies. So what I put at risk is let's say about 5% of my portfolio into mostly Feb and April puts, because I got them real cheap.
Sure.
And because I knew this is probably going to fall apart, but I don't know when, because the spread between the large cap and the small cap got so huge that the large caps have to pull down. And that was what I thought would happen. I don't know if it will. It's starting.
And that was like 3 weeks ago ish. Again, I'm likely generalizing, but it was kind of that that lull or ramp up period during Chris, between sort of the that last week of December, right?
No, it's the first week of Jan.
First week of Jan. Okay, so first week of Jan.
Maybe closer to 2 weeks ago, but it was the first week of Jan because, and I did it right away because I expected to see a negative momentum move at the beginning of Jan, like you normally would see, and it didn't. It went the exact opposite way, and a big time. And I was like, wow, we have a huge problem.
Yeah.
So
the following day though, I mean, they fell. They ripped lower, right, or fell off the cliff.
It was really
your
something.
Puts likely got it was.
But the large caps didn't move, and it's only now that the large caps are starting to move down. The QQQ housing stuff like that, and so now all my puts are in the money, And so now my book is very, very, very short. And
Got it.
it's so I'm probably protected on any sell-off though. In fact, I'll probably make money on any sell-off that we have. And I'll get hurt if we have a nasty squeeze, only because my puts are so much in the money. I stand to lose probably about 5 or 6 or 7% if we have a ripper in the market. But then again, my longs that I've held on to are also down, 35%, 30% on the year. So they might bounce really strong too. So I'm not really sure. Like, for instance, at the open today, I was down 3% because the market was strong and lifting. And I actually finished up today 3% because they turned around and sold them and didn't sell my longs so much as they normally do.
Sure.
So I really, I wish I was smart enough to tell you what's going to happen, but I'm very
No.
concerned. I'm very concerned that the selling has been this kind of persistent and And I'm not one of those guys that are like, oh, just follow the whatever the wind is in the stocks. I'm much more fundamental than that. But when I see an environment of a very extended stock market overall where everybody is all in. The Fed is pulling the rug out from under everyone, and we have a lot of retail in this market. I mean, we have a lot, and not only that, we also have a lot of foreigners in the large caps and everything else. Because if you're a foreigner, if you're in Japan or you're in Europe, and you see that the U.S. is going to spend that much money on giving away free money, they know what's going to happen. It's all going to go into stocks. And so they turn around and buy the shit out of the U.S. stock market, which they did. And that is also going to drive the dollar higher, because to buy U.S. stocks, you have to sell euro to buy dollar. And so that may have been one of the meaningful contributors to the dollar strength over the past year. And you see the dollar starting to fall apart. So if you're a vanilla tart out there in Europe, and you're like, I'm safe because I bought Microsoft, I'm okay. Well, Microsoft is down now 9.8% on the year, plus 4% FX that you lost. So the exit will be just as well, even more aggressive than the entry. And I think that is what we're seeing. So I think that after this Q, the 4Q results, they're not even going to wait for the 1Q results. I think they're going to use that as liquidity to GTFO. Get the
For
fuck
those
out.
that don't know, get the fuck out. That's
Get
right.
the fuck out. I think they're going to do that on the quarter. So I don't actually care what any of them put up. I think they're all going to sell. And that's going to be what they're going to do because they're taking too much FX risk.
Well, and you're seeing it even in the financials, right? I mean, J.P. Morgan was a good example of, they put up their earnings, right, and they were on the margin, not that bad, but the stock's off almost $20+ bucks, right, from the 170 down to we'll call it 150. So I mean, you're seeing this selling pressure that even good, basically. Good news is bad news, and bad news is even worse news, which we haven't had that in a long time.
And that's why I put on housing.
Yeah.
Because I looked at it and I was like, the setup is, because think of housing, like the market caps are too small for the vanilla guys care, right? They just don't care because the market caps, meaning the benchmark positions that they're in, is just too small. They can't make their year long housing, and that really leaves it to the hedge fund guys in retail that are the arbiters of what the price is going to be. And if you're blowing out numbers here on housing, which, by the way, is all backward looking, right? All the shit that they're earning right now is the plans they put in a year ago. So it's not about what's going to happen now. It's what's going to be happening at the year end in 2023. And so they're not getting paid for their beats, and all of the forces moving forward are against them. So just get out. And that's what they're doing. And I just can't believe, I tweeted when I put the puts on. So I didn't care what these guys put up. They're going to sell off. And I shorted the other one today that just reported big numbers too. What is that? I don't even know what the ticker is. CG something? Like, I don't even know. Is that CFG?
CFG, right?
CFG.
Yeah,
That's what I did.
Citizens Financial, right?
Oh, yeah, it's awesome. Don't even know what it is.
Yeah.
Don't even know. All that I know is it's super peaky and it's in housing. And actually, I should really look what they do. What do they do?
Are we talking about Citizens Financial Group?
Yeah. Provides a
They're
full
like,
range of commercial
yeah,
banking. Oh,
yeah,
so they're not really in houses. Oh, they
Yeah, they're
just
housing
do
bank.
loans.
yeah. I mean, they're like a mid-size bank
Okay,
down.
maybe I shouldn't be shorted.
I think basically down in the southeast, I believe primarily, but I don't know their details.
I think I just saw that it was in the ITB benchmark. Is it?
That would make sense.
Yeah, and so I would just like anything that is up in this benchmark, I'm shorting. And that was
So can we get into that for a minute? So what in IT is it just the Fed basically on ITV? Is that why you just think it's dog shit right now?
well, I also have a friend.
Okay.
I have a friend who's pretty serious in the housing thing.
Got it.
Have you looked at build-to-order housing companies versus the spec housing companies? So, for example, DHI, DR Horton, has fallen, 20% over the last couple of weeks, whereas someone like a KB Home has fallen much less.
Yeah, and KB
I
reported
think
on
that's
last
more
Friday,
hedge
right?
funds. I think that's more hedge funds where I'm positioning for hedge funds. I don't think I think it's just positioning for hedge funds. Why? They were probably long that and short the other. Because, this one's so much more expensive than the other, or we have to be long that and short this, and, and blow up.
Right. And I mean, that's your similar take on the biotech side too, right? It's like these funds are getting redemptions. That they need to go to the capital markets in order to get, basically fund that next round or, next phase of development, whatever it might be. And in order to do that, they're going to have to, price it incredibly aggressively in order to get that those millions of dollars through the door.
I think that there's a very high probability in 2023 we're in a recession.
Interesting.
So, and there's a big reason. There's a number of reasons, but there's one really big reason for it, and it has to do with the government spending. If you take a look at the past decade, the government excess spending over their, what do they call it, deficit spending, has been so large that it is the determinant to whether the U.S. has positive or negative GDP growth. In the event that our federal government has a balanced budget in 2023, or even close to that, you can shave 5% off of GDP. Now, what's probably going to happen in November is an absolute Democrat massacre. So you're going to have a very split Congress, and nothing is going to get through.
Yeah.
And I think that you are going to see a great reduction in government largesse because of it. So if you dial that in, they are literally going to put us into a recession, because it is government largesse that has determined our GDP growth for a decade. So if you balance it, we're instantly in a recession. If you spend 2% over, we're in a recession. So it's because the comps and the government has just become such a big part of, it's become such a big part of our GDP over the past decade. It's a liability. It's a big problem. And now with interest rates going up, it's going to be a bigger problem. Remember, if the short end of the yield curve, say 3-year, because most of the government is financed between 1 and 4-year paper, and if the 3-year is going to go to think about it. If we have inflation of 6, let's go crazy and say we have inflation of 5. How the hell is a 3-year going to be at 2? It's not.
Yeah.
Well, I mean, inflation should come down with growth, right?
Let's go crazy that the 2-year will be at 3, right? Well, that means that the government has to pay more than double for its financing. And right now, the government pays about 15% of our tax revenue to finance, to pay for the debt. And in the event that it goes to 20, we're instantly in a recession. So,
yeah, I mean, I think if you're getting, go ahead. Sorry, was that trend? Sorry, Ben.
so as you know, the Fed's job, and this I'll say it all the time, the Fed's job is only to make the Treasury look solvent. And right now, he is hitting the super oh shit button. Because if this keeps going the way it is, he will lose control of the long end of the yield curve. And in the event that that happens, it's over. We will have a bubble busting like you cannot believe.
I mean,
So,
what do you say?
What odds do you place on that? What probability do you place on that?
well, right now it's at risk, okay? And so the Fed is going to do whatever it takes to gain control of the long end of the yield curve. And the only way that he may be able to do it is to jam us into a recession to force everybody to buy treasuries.
Hey, Mike.
That's why I think we're in real trouble between now and 23.
Hey, Mike, do you think the pods running the bar model are in trouble? Because running a neutral book, most guys are up on the year, right? So just any thoughts on the bar model with the inflation hike?
It's actually the leverage problem. It's not really the borrow model. Millennium, Balyasny, some of the other pods, they run 4 times levered for relative value equity. That's the stock picking hedge funds. And and that's actually okay. They're going to be fine. The one that is outstanding at risk is Citadel. Because they run 9 times. And if the broker, if the terms go from 60 bips, which probably they're at right now, and it goes if it goes to 140,
the relation with Robinhood, and then all the retail guys get blown up as well. Yeah.
Oh yeah. Well, Citadel will have to by the end of the year, they'll have to take their kind of ratchet down gross and take it down to 7 times. Well, that means they need to fire 15% of the PMs. So because now we don't have enough money.
I mean, that's $60 billion of equities that they're going to sell.
Potentially. Do you still think it's going to be 5?
I mean, these PMs are rich.
Do you think it's still going to be like
no? The PMs are not.
Hold on, guys.
Hold on. Back up.
We got to back up. You got to raise your hand.
The PMs are not rich. He said they're all okay. The PMs are rich. There is only a fraction of PMs that make a serious amount of money. Just so you know, like in healthcare, we had 13 or 14 books at Millennium that were healthcare books. All right, and you probably had about 4 that did well all the time, and a whole. Now, granted, okay. Crappy PMs are still making $4 or $5 million a year. Okay, but there's only and not even that, but some of them are making $2 to $5 million a year. And if you're kind of at that $2 to $5 million, you're actually kind of at risk of being fired. But it's only about a third that are the real producers, and those are the guys that are putting away $20 million personally a year.
Right.
So it's really, when you hear all the hedge fund guys, oh, they're doing so well, I'm a hedge fund manager. It's really only about a third that are really good at it. And even on that, there's only about 15% of them that are consistently good at it, meaning that they'll have 1 year, good, another year, crap, really volatile. There's only about 15% that has a good year every year.
And Mike, that seems very generous looking at the hedge fund, the HFRI indices, because when we look at all the 8 to 10,000...
Oh, I'm sorry. I'm talking about the pods. So you can't see the pods. These are guys that are running relatively neutral. All the other, or most of the other hedge funds out there, the healthcare hedge funds, are meaningfully long biased, as evidenced by their recent returns.
Hey, Mike, is MLP still running 20 plus or minus, and then still 4x gross?
No. Well, it depends who you are. By and large, no. But if you have been there and made a serious amount of money for them, they will almost let you do whatever you want, because they know that you know how to do it and you know what you're doing. I mean, I was one of the few books there that would literally be at times 30 to 40% net short. And if you get that, that's a very dangerous place to be. And if you get that right, multiple times, and you're putting up $100 million years, which was a lot of money 5-6 years ago. Apparently everyone's doing that now.
Have they tightened up, or is it like still 5 and 10 and out?
It depends on the sector. I'll tell you what I had. I had a 9% kick out. I think I had a 7% drawdown to get my capital cut, and maybe 9% where they'd fire me. That's wider than most. Most are 7 to get fired. My contract, though, was, Millennium was a $9 billion firm when I came on. So it was pretty small, and I was like the biggest healthcare book by a mile back then. And now they're 7, 8 times that size now. So they have a lot of capital, a lot of books.
So at 7, they would take back half your line?
Yeah. Okay. But the industrial books are closer to 5 or 6, and you get fired.
So for those, so short bus, you're asking awesome. Clearly you got the knowledge, but for those that don't fully understand this, so in the hedge fund world, there's a lot of different moving pieces, right? So, Mike was running his book of business inside of a larger, a healthcare focused entity inside of a larger group, hedge fund itself, right? So he basically had leeway to, go and make portfolio decisions, right? For within his sector, and focused on certain companies, et cetera, and Mike was very, very good at that. So just wanted to kind of give people an idea, right? So when they're talking 7% and cutting the line, that really means that basically his he's not able to leverage up his book as much, and or kind of he has to sell some stuff down, right? So he's not getting the full tap on the shoulder, but he's getting a little bit of a, hey, you got to tighten things up here a little bit.
Oh, I got tapped once.
Did you?
Yep, I got half my capital pulled in 2013. I had an $86 million drawdown, and I got tapped, and they forced me to take half my capital down, and then I turned around and made $88 million on half the capital.
That's awesome. Good for you,
Mike. And I went into Izzy's office after that, and I was the best performing healthcare book for the year.
That's awesome.
And on half the capital. And I went back in his office and I said, you will never, ever pull my capital again. Because when they said that, I was like, you need to double down on me right now. This is wrong. And I think I'm probably the only person that I know of that had that kind of drawdown and didn't get fired.
Right, because most of the guys are targeting 5 to 7 on the
you'd be dead. You'd be dead. Well, the point is that I wasn't down on the year, by the way. I had been up over 100 mil. Okay. And it was like March, and I had this nasty drawdown. It was probably around that European debt crisis thing, because I really just couldn't figure that out.
Mm-hmm.
And
I remember you speaking about that. That was one area.
Oh, I learned everything about those Greek CDS. That was a big deal. Very formative for me.
I think we could have a whole hour conversation around this one subject alone, right? But
well, I learned a lot about central banks, and now I really understand how they think, and I'm a scientist, so I figured out what is it. Forget about what they're saying. What are they doing? And they are desperately defending the Treasury. That's what they do. That's the only thing they do. Everything else is bullshit. Full job creation, nothing else matters but controlling the long end of the yield curve, because we have way too much debt, and they know it. And all they can do is tell us everything's okay, but they will say and do whatever it takes to tame that long end of the yield curve. Because if the other countries decide that, or individuals decide that they don't want to own the long end of the yield curve in the U.S., it's lights out. We're having a horrific depression, and then they know it, and I know it too. So I'm going to bet on what I think they are going to do, and so far so good. So I just hope you're listening.
So we just want to quickly reset the room real quick. We want to reset the room real quick. So we have a larger than expected audience today. Thanks to the star power we have drawn. We have over 250 audience. So I just want to make sure I want to make
We
sure
got
we
the
have.
Gavin guy on here who talks from his car all the time.
Mm-hmm.
Love that. With the black and white, it's all
He's a
drama.
stud.
It's all
He's a
drama.
stud.
I
Yeah.
love it.
So just so everyone knows, this is a weekly notebook review that Rob hosts. This was Rob's idea, and in this we do a weekly notebook review with the standpoint of what our process we have, our observations across asset classes. Today we have a special guest in form of Mike Taylor, who was a biotech PM in the past, and he has been kind enough to share his experiences with us. Usually we do this every Wednesday. Sometimes it's at 4:30 p.m. Eastern. Sometimes it's at 8:30 p.m. Eastern. And I will, give it over to Rob for some of the hands that are up. They have been patiently waiting to quickly go through the questions, and then we can revisit the notebook.
Yeah, awesome, Trent. I appreciate it. Thank you very much. And you're spot on there. Yeah. So again, welcome everybody. This has been awesome, Mike. Thanks again for sharing all your knowledge. We do definitely have a few questions. So,
Sure.
Lewis, I know, Lewis, you kind of been up or had your hand raised for a minute. So again, just before we get into you though, Lewis, again, just to expand on Trent's comment there, a lot of us, follow the Hedge Eye research process. And the notebook is a big deal, right? And the process itself is a big deal. And for many of us here, especially on this call, we often have day jobs like myself, right? And we're kind of managing our own little tiny family office, not quite the size as Mike teased there, but it's still quite very important to us to get this right. And we've been spending again basically the last kind of 2 months doing this weekly session on Twitter Spaces to just kind of evaluate what we're seeing out there, how our weekend review has shifted by Wednesday, right? So coming into the week, how were we positioned, what were we expecting, and are we making kind of any moves, or what are we kind of looking for going into the end of the week, and then kind of positioning for where the puck is going, as we love to say. And it's definitely a Keithism that I've stolen, but it's definitely a good one, right? To kind of skate into where the puck is headed. And we'll definitely get into that in a minute. But right now we got so many questions and a lot of great commentary. So I'm just going to pass it off to Lewis, and the floor is yours, my man.
Thank you, Rob. Yeah, I just wanted to ask. This was a while ago, but Mike, you mentioned housing. Maybe like you said, maybe drawdowns of 40%. Does this intersect with what Rob Simone was saying to be long, like were any hedge investing ideas, like we had AMH, he said, and there was RH, what else, these like REITs. Is that like is that a problem, or?
Oh, I'm just going to be short the ITB, the housing ETF.
Gotcha. Okay.
And I'm actually short like just some names in between, but really not size. I'm really short the ITB because the setup that it had, the options. I mean, I bought my options all the way out to April, and now they're in the money. And I didn't know it would happen so fast, but when you get the right price, you get the right price, and that was
right.
it. And I put it on in size. It's just the setup is that everything, remember all this housing, it's backward looking, and everything is super peak right now. Everything's awesome. And hey, the input costs are going to go down over the next year. So it's going to be cheaper to build these houses. Well, what's going to happen is that as it gets cheaper, all of the mom and pops are going to step back in and start building houses again. These guys have nothing to do for the past 7-8 months. I know personally a handful of builders that have put up 2 or 3 houses in the past year. That's it. They usually do 8, and that's it. And it's because the input costs. They're like, I'm not sure I'm going to make any money. And so that's great for all these builders because they've kind of pushed them out of the way. But all of them are going to come back in the spring because input costs are going to come down. They're going to pour those foundations. They're going to deliver those houses right as financing rates are lifting substantially. So I mean, I go with that setup, and remember the incremental buyer. Think about who the buyer is. The buyer is younger people who are probably buying their first house because that's where all the money is. It's not the mega mansions, right? So it's all going to be these like lower to mid. I mean, the volume is going to be in the mid price range. And all of these guys have massive Robinhood accounts that have blown up, and they just got a bunch of free money they put into crypto that is blowing up. And so I think we're going to see a meaningful adjustment in consumer confidence just as all new housing inventory comes online. So higher costs upset investors. All these things play into, and honestly, look at the ITB in 2019. It was at 35. It was just at 80. And that's like a lot of spaces here that have massively over-earned on the free money gravy train. So this is just a post-COVID trade, just like Moderna. It's just a little later. Here's another one. Tomorrow, Signet Jewelers. Same fucking trade, by the way. Signet Jewelers was a total POS fraud balance sheet bomb in 2019 that made about $2.95 in earnings. And it was trading at, I got to pull up the chart. And by the way, I'm not a consumer guy, okay? I just watch a lot of stuff.
While you do that, Mike, I just
2130.
Yeah, and Lewis, I think just if we bring kind of to the review a little bit here, over the weekend, Lewis, ITB, if depending on what signal you're looking at, what have you, it did go neutral, right? So, and on the pin sheet this morning, it's neutral, right? So it definitely.
Oh yeah, that changed. Was that a change today?
It happened today, right? So it went from a bullish trend to a neutral trend. So it's a big, so you definitely got to pay attention to that kind of stuff, right? And what Mike does though, what I noticed over the weekend was I was putting in a lower high, right? So that to me is like a signal to lighten up, and then you start diving in under the hood. And this is really, again, I don't want to put words in your mouth, Mike, but I believe you're seeing that DR Horton, Lennar, they're some of the top holdings inside of the ITB. So he's looking at it from, okay, there's the underlying components here are weakening, and that kind of thing, right? So again, Mike, I don't want to put words in your mouth.
No,
but
that's absolutely it. I just wanted to show you some corollaries of the same people that buy this shit, these houses and stuff like that. It's the same people that bought Yeti. Everybody got a Yeti. Nobody needs more Yetis. I'm short Yeti. The sell side just modeled them to have 20% growth forever. Signet Jewelers, this stock in 2019 was at $15. It's currently at $87. They report their December revenues tomorrow morning. I don't care what they say. I hope it's a good number because I'd love to see the name squeeze up. But the street, you'll love this. Signet is the same thing as REIT. It's the same thing. It's all these low-end individuals who got a whole bunch of free money and bought shit, including houses. And it's all going away. Signet Jewelers did $360 in the calendar year in 19, $138 in 20 because of COVID, and then 21. Are you ready? $11.35. $11.35 because everybody got free money. Went to the mall and bought a necklace with a charm on it. It's beautiful. And the street models them to do about 10 or 11 bucks every year moving forward because Signet Jewelers is back. And I'm willing to wager it is just a COVID trade, and it is going to blow up horrifically this year, like crazy horrifically, like at least get cut in half. And I think that the housing stocks are actually pretty similar, deteriorating fundamentals, all on the look forward.
Mike,
so there's another short for you tomorrow on their sales number. I don't care what they print. The stock is, you have to sell it. I hope it's a great number. I hope it squeezes up like 10%. 8% short interest in it, and I'm short it, but I want to be short multiple 7 digits of this thing.
I love that.
Mike, and I'm only that was incredible. That was.
I'm just trying to segue, baby, segue.
Yeah.
And Rob, thank you so much for doing all this. I love the community that's developing here around Hedgeye, and I want to be part of it. That's
Oh,
all.
that's awesome.
That's all I have.
Yeah, absolutely, my man. If you don't mind dropping off as a speaker, because
Yeah,
we got
yeah,
a few
of
others,
course.
and unfortunately, we're just kind of capped at 10 speakers and 2 co-hosts, so that'd be awesome. I believe
Yeah. No problem. Thank you.
Thank you. No, I appreciate it, sir. Thank you. I can't see your last name. Bio Lear, maybe Bio Lear or something. I think you were up next. Yep, go ahead.
Bio learner. Yeah.
Bio
Hey.
learner. Sorry, man. I can't see the rest of it. My bad.
That's
buddy.
okay.
Go right ahead.
Thanks a
Floor's
lot.
yours.
Hey, Mike. I'm a long-time follower.
Oh, I'm so glad. Thank you.
I'm a physician, and I don't know how you have heard about Shockwave Medical. I'm pretty sure you have.
Shockwave, yeah.
Yes. And their IVL catheter is amazing. In patients, it works like a charm. The calcified lesions you cannot angioplasty with other simple angioplasty balloons. Shockwave creates them like a butter. And they have some patent issues with CSI Medical. And there was a rumor about Penumbra. That was just a rumor, I guess. But my point is, it's an open market for them. There is some patent issue going on. They are doing headway in cardiac indication. But, because of that hangover and rumors, the stock came down from 250 to 144. So what do you think about this hangover of patents and, all these rumors and this long-term prospects of, buying Shockwave at this point?
Well, as you know, if you don't have IP, you don't have much, right? And that's your intellectual property, right?
Yeah, absolutely.
Isn't that like super bad?
Yeah, it is bad, but I thought they still have some IP. They lost appeal against some. So again, you're right. There is some issue with the IP, and that's where I'm not expert or not clear about. So
I'm literally buzzing my super. Hold on, let me see if he's online. Oh, he's not online. I was gonna buzz my medtech guy who sat next to me I hired him at 23 years old out of a banking program. He's the #1 book at Millennium in healthcare. He worked with me forever, very close. I was going to ask him about this because he'll know instantly.
Okay.
What I can tell you, what I do like about this company, because I'm not close enough to it to tell you the IP problems. I believe it or not, I do have limited bandwidth, and I actually don't know. I know a lot of stuff, but this one I don't know on the IP situation. The good news for it is that it is not owned by hedge funds, and that probably means that hedge funds are short because none of them own it. The bad news in this name is that Gilder Gagnon owns a shit ton of this thing. And they are a Momo, grow, balls to the wall shop. And they are number 6 on the shareholders. All the others are benchmarkers for the most part. And well, I'll tell you 2 things. Gilder Gagnon is getting smoked right now horrifically. So is Fred Alger. So is Bailey Gifford. But they never sell. And so is Artisan Partners, because they all own Rocket Fuel in their books. And importantly, like I just showed you earlier today on Twitter, because a very fine, brilliant gentleman on this call, hosting this call actually, was making fun of my pink fund because it's down a little bit. And then I showed him that, well, you should see the T. Rowe Price Healthcare Fund. Well, T. Rowe owns 9% of this company. And so I'd be a little concerned about this holders list who's in it. Because they're getting hurt. They're getting hurt. And they own a lot of it.
Yeah, in medical community and physician community and medtech community, the reps, the device rep I talked to who are in this.
Ooh, wait a minute. Oh, wait. So this Shockwave is, hold on. How expensive is this?
It's pretty expensive. It's more expensive than angioplasty balloon. And
no. I meant the stock, not the process.
It's $5 billion market cap, 144.
Yeah, but they only are. I mean, like they're on the on ramp for earnings, but It's extremely expensive. This is exactly the kind of shit that, oh my God, it's really expensive. Holy shit. In this market, I would absolutely not be long this.
Yes, I agree. I'm not long this. I'm just looking at it, and it's amazing product, growing like a weed, and that's why I thought it's a good question for you to ask.
Well, here it's going to be about the rev beats.
I think it is a good question. I don't mean to interject, but I think it is a good question, BioLearner. It's just maybe for a different space or a different situation.
Yeah. Well, I mean, I will say this.
But
revenue
it's a good question. It's now on my radar. It was never on my radar, so I definitely appreciate it.
I got to tell you, I just want to follow up on this on the revenue beats. These beats are not big enough. Okay. For a market cap like this, and they're beating revs by $4 million. Like they had it's going to be lumpy a little bit last year because of the COVID on and off. So it's difficult but like 3Q is pretty clean, and they beat by 4 million on the top line. That is not enough. That is absolutely not enough for something of this market cap. You need to be smoking numbers to be this market cap. This is a very dangerous stock to be long. I would absolutely not be long this, no matter what the circumstances are in this market.
Thank you. I appreciate it. Thanks for input.
Awesome. Appreciate it, BioLearner.
Here a little bit to next week's setup, right? So a couple of things are happening this week. We have the OPEX expiring. Usually after OPEX starting Monday, there's a little bit of a seasonal rally in play. But also there's the Fed meeting on Jan 25th and 26th. So we'd like to get your thoughts on the setup that you're walking into, given this week's bearishness and higher volatility due to the classic OPEX, and then exiting that into somewhat of a relief rally Monday, Tuesday, but again heading into the Fed uncertainty. What are your thoughts?
I don't think we get a relief rally on Monday, Tuesday. I'm actually worried that we get an air pocket going the other way.
Yeah.
I could be wrong. My numbers are 59% of days through my career I've been up. So just assume I'm wrong 41% of the time. Okay? But I don't think we get an air pocket. I think it goes the wrong way. I think every single little lift we get right now is the air pocket. And that's it. That's your lift. And I think there is a lot of selling, especially in large cap, on the horizon.
I mean, I certainly, I mentioned this earlier, Mike. I mean, I certainly took that approach today, right? On especially getting rid of the remainder of my tech that I hadn't sold yet, that kind of thing. Some of these larger caps, right? Even some of the small caps, like Penn, I booted.
Oh God, yeah.
I mean, I just had enough, right? It's just like
DraftKings, Penn.
They're all.
I'm so mad I didn't short DraftKings. I'm just so mad I didn't short it because I'm just like, how the hell are you going to compete against 50 other? I mean, Jesus Christ, Kathy Wood. I mean, could you pick a bigger number of busted companies? It's unbelievable.
I know. But then on the flip side of that, you got Las Vegas Sands, right? If we're talking about kind of individual stocks, that is one of the stronger ones out there, especially in that space, and obviously, and also kind of getting the tailwind of China improving too. So, it's really cool to see kind of that macro development, right? You're getting China starting to pick up speed and kind of turn bullish trend, or at least bullish trade.
But China didn't pick up speed though. This is just up because people were worried that China was literally going to take away their licenses. That was the worry.
I mean, fair enough. Yes.
And so they basically said, we're going to give you 10-year licenses now instead of 30-year, and stay tuned for more details, which usually means bad. But but that's why I think it lifted here. I'm not actually touching the casinos in part because all the free money is to the low end, the bottom, whatever, 60% of the population is gone. Yeah. And crypto is down and everyone's upset. So
do you think, going back to Trent's question about kind of the Fed meeting next week, do you think much comes out of it, or is it still going to likely be kind of like teetering on a March Fed, potential rate hike, that kind of thing?
I think the Fed is going to. I think the Fed is sincerely scared, and they need to tame this inflation, or they will lose control of the yield curve. And so they are just going to hammer away. I think they're going to hammer away until stocks are down 25%, and then they'll blink. Maybe. Perfect. If the yield curve, it's going to be hard though, because I've kind of gone over this with my friends. Remember, the biggest inputs into inflation are the rental rate equivalent, which is heavily tied to wage growth, and wage growth has a very, very meaningful tailwind everywhere. And I'm not exactly sure what the reasons are for it. I am not exactly sure. It might be because literally COVID kept all the illegal immigrants out of the US. And so we have a smaller black market for illegal workers. And I know this from my construction. I know this from my construction and friends. And that's actually a big problem. Illegal workers fill a huge gap in restaurants and all that sort of, and now you have to pay people more because you need, there's just Americans left. And I actually think that's a big problem.
I don't disagree with you, but on the flip side of that too, though, you know how, majority of corporations are, backward looking, right? And certainly from a projection standpoint. So they have a good year, and then all of a sudden they, give a manager or multiple managers across the country say, they've been begging for new hires, and they finally give them the budget for it, right? So, it's kind of, I think it's a little bit of both. I mean, I'm just speaking from a firsthand perspective. We just lost our, one of our best sales engineer from a software sales perspective, and he went and got paid basically 3x what we were paying him, and we were paying him pretty good money, and from one of our competitors. And so, it's a very competitive landscape out there, especially for top talent. And
oh God, yeah.
Now we're back in the marketplace, and realizing that, we were likely under, at least in this environment today, right? Which I'm not saying is normal, but it's, we were certainly, certainly 50% lower than we need to be paying him 50% more at least, and likely kind of, 100% more, aka 2x what he was making, and he got 3. So, there's definitely a component there as well where, everything's groovy, right? I mean, they, the CEOs and heads of managers, they don't really look out, for a recession in 2023, Mike, in going into 2022. They're looking at their budgets and that kind of stuff, and everything's been gravy, and so you're seeing, there's a lot of hiring happening out there, and people are having to spend big money in order to acquire good talent.
Yeah, I mean, look, I've been doing this for 20 years. I haven't seen this.
Yeah,
this is the first time I've seen it, and look,
it's the first time anybody. I mean, COVID
that's right.
created
You
a whole
have to remember
situation.
That the vast majority of money managers right now have never seen an inflationary environment, so they have no idea what to do.
Sure.
And I'm not saying like I do, but in my experience, meaning just reading and talking to old timers, because there's a handful that are retired but available, and that the take home is stocks don't work. Okay, that's it. Stocks don't work. That's it, and that's all I need to know. Ford down 8% today.
Totally,
big win.
And BioLearner, I'm not trying to kick you off, buddy, but do you mind dropping from and just turning into a listener? And then other side, Mitchell, welcome. Thanks for joining, and the floor is yours, my man.
Yeah, I don't have much. I've been listening for a little bit. Mike, curious. We've talked about this on the call for the last handful of weeks, and something I've mentioned, but I want to tie it into what you've mentioned. You're talking about the Fed gonna raise rates, stocks get hammered, and then the Fed will come in and try to do something, right? So, given the fact that the vast majority of the SPIVs can't be utilized based upon the CARES Act getting rid of it, what are your Fed solutions where they don't run into a political nightmare in the second quarter here, let alone 2023? right?
Well, there's no political nightmare for him because he got his seat. And for the Democrats, they did the polling because that's all they care about is the polling, and they can't think past whatever the polls say for the minute. And I don't want to say both. It's sort of like the Democrats are horrible and the Republicans are like just a touch less. And that's how I view, both sides. And they polled the biggest problem is inflation, right? Because they're the people that they really cater to is, I mean, they basically carry most of the minority underprivileged population, and their biggest problem is inflation. And so he basically got the Fed to agree that he is going to do whatever it takes to get rid of inflation. Now, the reality is he's going to do it anyway because he can't lose control of the yield curve. And if these wages, if these wages continue to persist, like this, even if it's just for a year, we're still going to be looking at 5% inflation next year, and you can't have the short end of the yield curve at 1 and inflation at 5.
I apologize. Maybe I'm not framing the question properly. So yeah, say they hike, and you have the equity sell off that you think is coming, I think is coming, whatever. The Fed now has to react to that 25% off, right? So what is the Fed going to do when a handful of years ago, what saved markets was them coming in and backstopping corporates, them coming in and backstopping fallen angels through the SPIVs, right? The special purpose investment vehicles.
Oh, you're talking about a cataclysmic bed shit.
Well,
okay.
25% drop, they're going to shit themselves, right?
No, they're not though. That's what's different right now. They're not going to shit themselves until CDS, investment grade, actually junk CDS starts to lift. All right.
Start to blow out, right? If
we're down, so put on your screen right now.
Blown out?
Put on your screen right now, and I have it on all the time. Investment grade 5-year corporate CDS. That's what I want. And that's not going to start to blow out until companies start missing numbers big. And I'm not sure that that's going to happen yet. And what you may see, and this actually what the Fed, so here's what the Fed hopes. The Fed hopes that the whole yield curve holds this shape and stays, up and to the right and simply lifts, okay? Where the 10-year goes up 1% and the short end goes up 1%. All right? They want it to stay this shape, growth, and they want the whole yield curve to lift. That's what they want. They will only start to panic when the yield curve flattens. Okay. Because the economic data becomes a real problem. Okay. And I don't think that we are close to that.
That's
even though stocks may suck, he will focus on the yield curve. See, it doesn't matter if real earnings are still chugging and stocks suck. That's just leverage coming out of the system. And he'll view that as a good thing because that'll give him room on the other side when we have a recession in 23.
So that's what you think is going to happen, which I can respect 100%.
No, we'll have a flattening yield curve. We will have a flattening yield curve.
What if we have a flattening yield curve? What if they have to come in, but they don't have the ability legally to do it based upon them losing that ability when the CARES Act came in late 2020? They can no longer use those SPIVs. So what is your thought on that?
Don't worry.
They'll come in.
They'll make up spoons or spit or some other acronym. Don't worry. They'll make a new acronym.
They make the new acronym, but technically, by the law, they can only do that with congressional approval. That's what the law said. So that's my question. You have now Republicans, Democrats in a midterm election head to head with each other. That's the thought that I was trying to pull from your head. That's all.
I think the Fed is going to do nothing but raise this year. So I don't think that we're going to run into a problem that soon. I think that the problem is going to be closer to year end and 23. So I think that you're a little bit premature in thinking that the Fed has to act yet.
Okay.
But I would be looking for in 23, dare I say it, an inverted yield curve.
And then are you thinking the house is flipped at that point in time, so you don't run a regulatory?
Well, a couple of things flip. Congress is definitely going to flip. The Democrats are going to get absolutely massacred. But also housing stocks will actually be a very good, interesting buy at that point. But that might be a year away, and actually maybe a year and a half away.
Well,
interesting.
Yeah, so I think you're a bit premature in thinking about how they can save everything, because we're 5% off our highs, 7% off our highs, off of incredible highs.
Yeah.
So I think
the $1.3 trillion spending gap in GDP crushes. I think that in Q2 of this year really crushes GDP, and I think what you're thinking next year, and I say this respectfully, I have no fucking idea. But I think what you're thinking happens next year happens in the next 3-4 months.
Well, you are much more bearish than me.
Yeah, that's going to be scary as fuck.
confirming my my position. I'm 71% net short.
Well, I could be wrong. This is just a couple guys spitballing. That's all.
Yeah, no, that's actually very. I'm not worried about it, because I need to see corporate earnings get into trouble. Now, we're really set up, though. I mean, if you take a look at junk, we are super peaky. And I had a call recently with Brigden, Julian Brigden, on macro. I don't know, what is it? Macro Vision? Is that what it's called?
Yeah. Julian,
isn't that terrible? Like, I don't even know the show that I was on.
Yeah, MI or M1, 2, MI.
Yeah, he's MI2. And I've worked with the guy for 15 years. And he's an extremely brilliant guy. And he said, Mike, what is the one trade for the next 2 years that you can't be wrong on? And I said, long junk CDS.
Right.
Because we will go into a recession off of this. And junk CDS are free. And all these things are trading at a 4% yield or less. I mean, this is really something. And so I think that's like, I had to come up with, if I had to come up with the trade that I don't know how it doesn't work, it's long junk CDS. So unfortunately, I don't have an ISDA account, so I can't put it on.
Right.
I just have to be short more Moderna instead.
Right.
So.
Yeah, Mike, you're gonna have to get a TikTok and just do a dance about junk CDSs and how you want.
Oh my God!
Yeah, you want to be long.
I've been encouraged to do all this sort of thing.
I'll drop off as a speaker. I appreciate the time. Thank you very much. Talk to you guys later.
Mitch, always a pleasure. Gavin, Brian, I know you've raised your hand for a hot minute here, buddy. If you can hold on for like 30 seconds. Gavin, I know your time is kind of a hair limited, and I actually had a question for you ahead of time that one of our guys, Chirp, he had a question for you around what you were seeing in oil coming into kind of our weekly review last week, and then kind of into the weekend, that sort of flagged for you that it definitely wasn't a short, and then kind of how or if you're positioned for any shorts today, and or what's jumping out of the page in your notebook this evening. So Gavin, floor is yours.
Yeah, Chirp always comes in with those questions. Is he in here right now?
I believe he is, but
here he is.
But we got there's a lot of speakers